You've seen the ads, get exclusive access to the next big AI company before the IPO. But if you're getting that ad, they don't see you as the smart money. They see you as the exit. These platforms make it sound like you're finally getting the insider deal, the one Wall Street kept to themselves. But there are three things they never tell you. They don't tell you what you actually own when you buy those shares. They don't tell you who is on the other side of that trade and why they're selling. And they don't tell you what happens to your money if the IPO gets delayed. We're going to walk through all three, and then I'm going to show you where the real edge lives. Hey, welcome to New Stock Signals. I'm Max, the digital twin of Bill Smith, founder of Renaissance Capital, which for over 30 years has analyzed more than 11,000 IPOs. Bill personally researches and writes every video script himself. I hope you enjoy. He reads every comment, so be sure to share your thoughts below. Nothing in this video constitutes personalized investment advice. Always consult your own financial advisor before making investment decisions. Let's get into it. Here's why this matters right now. The AI IPO wave is building. Transformational companies are going public, and a whole industry of pre-IPO platforms has emerged to offer retail investors what sounds like early access. The pitch is compelling. These companies stayed private for years. You missed the venture round, but now, finally, you can get in before the IPO. Here's the reality. By the time that deal is being marketed to you, the structure is already set against you. This video is for investors who want to understand that structure before jumping in, not after. Let me start with the information problem. Ask yourself what you actually know when you buy pre-IPO shares. Private companies don't file with the SEC. There's no 10K, no quarterly earnings, no audited financials you can rely on. What you have? Pitch decks designed to raise money, press releases designed to generate buzz, and valuations from funding rounds that happened months, sometimes years ago. Now think about who is on the other side of that trade. They've been inside the company. They've seen the internal dashboards. They know the burn rate, the customer churn, the deals that fell through, the key executive who quietly left. Here's a rule I've followed for over 3 decades. Never invest where the other side knows dramatically more than you do. In pre-IPO markets, they always do. When a company goes public, that changes. The S-1 filing reveals the business model, risk factors, insider ownership, and audited financials. Quarterly reports follow. Analyst coverage begins. Management answers questions on earnings calls. Same company, completely different information environment. Here's what really matters. There are 3 structural traps built into pre-IPO investing. Most people don't see any of them until it's too late. First, there's the valuation illusion. When a platform tells you a company is valued at $10 billion, what does that mean? It usually means that 12 to 18 months ago, in a negotiation between the company and sophisticated venture investors, they agreed on that number. Those investors did not buy what you're buying. They bought preferred shares with liquidation preferences, meaning they get paid first if things go south. They got anti-dilution protection, board seats, information rights. They negotiated for months. You are buying common shares, no preferences, no protection, no negotiating power. That $10 billion valuation was for a different security with different rights. Comparing your common shares to their preferred shares is like comparing a general admission ticket to owning the skybox. And private companies avoid down rounds at all costs. They would rather delay raising money than admit the valuation should be lower. So that stable $10 billion number might be masking deterioration that only shows up at the IPO, when real buyers and sellers start setting value every second. You bought at the negotiated fiction. You sell at market reality. Then there's the liquidity trap. Suppose you buy pre-IPO shares and the company is doing well. You want to take profits? You usually can't. Pre-IPO investments are illiquid by design. You might face holding periods of 6 to 12 months before you can even think about selling. And even then, you need a buyer, either through the platform or another secondary transaction. If the IPO gets delayed, which can happen, you're stuck. If the company has a right of first refusal, they can block your sale entirely. Pre-IPO platforms rarely lead with this because illiquidity is a feature for them, not a bug. Once your money is in, it stays until they say otherwise. Finally, there's the seller question. And this is one changes everything. Why is this person selling? If the company is about to be worth dramatically more, why would an insider, someone with far more information than you, sell their shares right now? There are a few explanations. They may have large gains and want to diversify. That's rational. They may see something concerning and want out before public markets scrutinize it. The company may be pushing secondary sales because it can't raise a new round without a down valuation. Venture investors may be quietly trimming exposure while publicly talking up the company. You have no way of knowing which scenario you're in. The seller does. When a company is public, insider selling is transparent. Form 4 filings show every transaction within 2 business days. Lockup expirations are public. You can see when executives are buying with their own money, a genuine signal worth watching. In pre-IPO markets, you are flying blind while the other side has radar. So where does the real edge live? I believe the answer is what I call new stocks. Companies within their first 3 years of being public before they join the major indexes. Here's why that window matters. When a company IPOs, there's initial volatility. Institutions are still building positions. Analyst coverage is ramping up. The market is figuring out what the business is worth. Then, at certain size thresholds, the company becomes eligible for index inclusion. Passive funds that track major indexes become forced buyers. Massive inflows can drive prices higher, often before the fundamentals fully justify it. Your edge is the window before that happens. In that window, you have the same information set as institutional investors: full SEC filings, public financials, earnings calls, real-time price discovery. And you don't have their constraints: minimum position sizes, investment committee approvals, compliance hurdles. In that environment, an informed individual investor can compete. That is not true in opaque pre-IPO markets. And it's less true in mega-cap stocks where you're competing against armies of analysts. New stocks are where the structure favors you. Pre-IPO markets are where the structure is set against you before you arrive. Let me be direct about something. I'm not saying pre-IPO investing is always wrong. Some investors have the access, the information, and the risk tolerance to navigate it well. But that investor is not the person seeing a mass-marketed ad on social media. If a pre-IPO deal is being widely marketed to retail investors, you are not getting exclusive access. You are providing exit liquidity for sophisticated sellers who have decided now is the time to get out. I also want to be honest about what I don't know. Some of these platforms have evolved. Some provide more disclosure than others. Some companies that traded on secondary markets before IPO have gone on to perform well. The structural disadvantages I've described are real and persistent. They are not a guarantee of loss, but they are a reason to demand far more information before committing capital, and to ask hard questions about who is selling and why. The discipline isn't avoid this category. The discipline is understand the structure before you participate in it. Let me bring this together. Pre-IPO platforms are selling the idea of getting in early, the sleek interface, the exclusive access, the promise of venture-style returns. What the structure delivers: an information disadvantage, stale valuations, illiquidity, and sophisticated sellers on the other side of the trade. New stock investing offers something different: full transparency, real price discovery, immediate liquidity, and a genuine window where an informed individual investor can compete before institutional money fully loads up. The best time to buy is rarely when insiders are selling in the shadows. It's when the company is public, transparent, and the market is still figuring out what it's worth. That's the edge, and it's available to anyone willing to do the work. If this gave you a clearer framework, subscribe. We break down the IPO market using the same approach we've applied to over 11,000 IPOs across 3 decades. Drop a comment below. Have you ever been pitched a pre-IPO deal? I read every comment, and I may break a few of those deals down in a future video. The best deal isn't the one they call exclusive. It's the one where the information is open, the price is real, and the structure is on your side.